to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. Actually, it's good to be back. I have been watching what's going on. It's very fascinating. The S&P 500. Probably not the best indicator to look at, but it's a very good one. There's no doubt about it. Anyway, the volatility has been pretty intense. Not unusual, though. You know, that's one of the things that I keep talking to people about. I get some people who call in who haven't called for a while, and I haven't talked to for a while, and they'll go, well, your phone must be blowing up, and actually, not so much. Especially this time. I guess people have been listening long enough and have gone through enough stuff to just kind of relax. You know, that's a good place to be. If you're not at that place, give me a call. You know, yeah, it's getting kind of slow. It's literally getting kind of slow in my office. I'm surprised. It's amazing. If you look at where the S&P was, you go back to 2018, at the beginning of 2018. So you're, coming up on 2 years here, and the market's actually the same as it was during that time period. So, and in between those times, it was down almost 20%. Actually, it was down 20% from its peak because it made a new high in 2018. You had a little sell-off in the first quarter of 2018. It climbs back up, goes to a little new high, then comes down really fast, a little bit over 20%. And recently it took out those old highs and then it pulled back again. And you know why it does that? Because they're stocks. People hate when I say that. I'm sorry. I'll try to refrain from doing that in the future. But it's the truth. I mean, when you look at how much has changed in the past month, not much. I mean, in the month, nothing. There's been nothing. This stock of trade war has been going on forever. This is nothing new. Yeah. In fact, we're going to be doing a seminar on that. How might that affect your investments? And ultimately, what happens with most trade wars is the consumer gets to foot the bill. That's what happens. Inflation is the result of a trade war. And we'll talk a little bit more about that a little bit later in today's show. But if you did want to sign up, by the way, we're having a workshop, our seminar, and it's coming up pretty quickly. In fact, I have to look it up because I don't memorize the dates of my workshops. And I'm going to go right to my website, bullingtoncapital.com. And you type that in there. You go click on it. It says seminars. Click on there. And we're going to be doing the, by the way, I just had Melissa, poor thing. She's on trying to enjoy her weekend, and I'm texting her saying, "Hey, you forgot to put the address on the on there," so she had to go in and alter that while right before the radio show. So anyway, trade disputes and how that may affect your investments. Trade disputes are really a harbor for inflation. That's the end of the not the end. That's the vast majority of the reaction to a trade war is going to be higher inflation. And what does that mean? Well, it means your dollars buy less. That's what it really means. Well, think about this for a second. If we put taxes on a foreign good that are coming into the United States, you think the foreign companies are going to pay that? Think they'll take that on the chin? They're not going to do that. They're going to let the consumer pay for it. They're going to get upset because we're taxing their stuff and it makes it less competitive. But bottom line is, it's the consumer that ends up paying. And when they change their exchange rates, I'm going to give you a couple of examples at the seminar. And by the way, the seminar, it is September 12th. That is let's see, I think it is. You know what? This is really killing me now because the actual date's not up there. Yes, it is. It's to the side. It's not on the, so, phew. I was panicked for a second there. Anyway, September 12th, that's a Thursday. There's no cost, and I'm going to give you a couple of examples. By the way, the calculators that didn't come in for the last seminar, they're here now, and then but they did come in for the last seminar. I take that back. They didn't come in for the one before that, and then I forgot them. So I still have them. I'm going to give you a little calculator. We'll go over the 60-second test again very quickly, because that one really doesn't need that much work. But if you don't know what that is, it's how to tell whether a stock is potentially undervalued or overvalued in 60 seconds or less. And we'll talk about trade disputes, how that can affect your investments. What may you want to start doing about that now? And, even though that the interest rates have come way back down, and see, this is a key. We're going to be making an adjustment somewhere in the next 4 to 6 months in the portfolios that I manage. We're going to be shortening up the maturities on the bond funds that we have. It doesn't have to be done tomorrow, but somewhere over the next few months, you're probably going to want to have shorter maturities. What kinds of securities, what kinds of investments should you be looking at? We're going to talk about all that stuff coming up here, September 12th. In a seminar, and I'll have very specific examples of what kind of stuff has held up the best in the past, whenever we've had a situation like this, because this is not the first time interest rates have been this low. It's the first time they've been this low with GDP growth as fast as it is. Normally when GDP growth is 3% or better, interest rates are typically around 4.5 or 5. So when they say it's different this time, it's different this time. And interest rates are nowhere near as high as they usually are when you've had an economy that's, worldwide that's going this good. Everybody keeps waiting for that other shoe to drop. I got news for you. Professional economists, people with PhDs, have correctly predicted 24 of the last 3 recessions. I gave you a second to think about that. Yeah, if you always say there's going to be a recession, eventually you're going to be right. Now, it's like a broken clock. It's right twice a day. And it doesn't have to do anything to be right twice a day. And if somebody said, hey, these guys are right twice a day. And if you listen to that and you listen to the tone of voice, you would think that was actually meaningful. Yeah. Right before you realize that there are 24 hours in a day. and they stop and they start over at 12. So it's not that significant. That's another thing. I keep hearing about this inverted yield curve. You know what? If you go back to look at every time the yield curve was inverted, it's not all that significant. It's not. It doesn't have a 70% correlation. Yeah, in fact, I'm not even sure what it is anymore. I did look it up and I forgot. But it was not really statistically significant. And it's not just the fact that those things are happening. It's why they're happening that really matters in the long run. And what do we have today? We've got a strong economy. The economy worldwide, it's a little weaker than we would like it. I mean, everybody would like to see better growth. It's just one of those things you really like. But the growth rate's okay. You don't have any of the big drivers of the worldwide economy that are in negative territory. That's a good thing. In fact, at some point in time, I can tell you one of the reasons that United States bonds have gone up so much is that in some countries, they're literally charging you to hold on to your money for you. They're not paying you interest on that. You have to pay them. You have to pay them to keep your money safe. You think about it, that actually makes sense. If you can't make any money lending money because your interest rates are so low and you want to keep your money safe, you may end up having to pay somebody to keep your money safe for you. I wonder if that's ever going to happen in the United States. I never like to say never. Is it likely? Probably not, but it could. It could happen. I don't think it's a huge. You never know. I mean, there are several countries around the world. I never thought you would see people paying a bank to hang on to their money. Yes, let me give you $10,000 so that I can get $9,970 10 years from now. That, and that's essentially what's happening in a lot of countries around the world. I mean, it's, we look at it, go, wow, that's crazy. I'll tell you what was really crazy, and I was born in the wrong time. Crazy is when you could get an 18% money market. That was crazy. You get a treasury bill, a zero coupon treasury that would guarantee, but from the United States government, who has the ability to tax, by the way, you get a guarantee that you put $1,000 in a bond and they'll give you $2,000 in 5 years. Think about that first. That's crazy. That is super crazy. By the way, that's a lot more damaging to you financially. Because the only reason that they would pay that much interest is that the inflation rate, it was in the low teens back then. So prices were going up and people, I don't have to spend the money. Really? You're not going to eat? You're not going to eat because in prices gone up. It's too expensive to eat. Give me a break. You're going to eat. You're going to drive your car in America, especially because we're spread out. It's not like Europe. It's not like China. Yeah, people here live far apart from one another and their jobs and the grocery store. Okay, so you're going to drive a car and you're going to pay more in gas. And that kind of stuff it's just as bad as having your money go down in value. It's just as bad. So if you got a 13% inflation rate and you have to pay taxes and you're only making 15% on the investment, you're negative. You're negative. Okay. So these negative interest rates around the world, they're not quite as negative as people were by buying those 15% guaranteed government bonds. That blows my mind. Anyway, I got to take a real quick phone call. Feel free to call us 216-901-0945. And John, you have a question or comment?
Good morning. Good morning. Hey, I think all dressed up and no place to go, and I think the uncertainty is the worst enemy. What is happening to recycle NAFTA? Are they waiting for the astrologer to come and get these things signed up, or what is it?
You got me.
Supply chain is not just UPS alone.
Right.
They got the best tools in the world. UPS is not a brown truck. They probably have the best supply chain in the world now. And, of course, people don't appreciate it. I don't know where's Navarro.
Well, they don't know about it because they're behind the scenes.
I mean, they always say learning curve and ahead of the curve. Why are the curveball? Maybe they're going in circles, inventing the wheel. How is that?
Yep, that sounds like
it's a shame because just in time, years ago, when we tried to get behind the just-in-time thing, for want of a nail, we lost the whole thing of the auto industry in Canada, right? And shut up everything in Dayton and here and all over.
Right.
I don't know what's going on. Some of these people, they're shell game, and it's sad.
Well, you're in good company because I'm pretty sure nobody else knows what's going on either.
I mean, the Congress is, when you hear these hearings, I think we have to change a new expression. Nothing to do with the high beam and deer. At least deer is, you can eat afterwards.
Yeah.
And this is sad because I've been watching C-SPAN for 29 years or 30 years almost.
Yeah.
Minimum.
Wow.
This is
and you haven't shot yourself yet?
No, I mean, 1979, I think, when I started watching in 1980. And that's my first baby every morning and whatever night.
Yeah.
And, of course, yesterday they were talking about all the robocalls. And
I stopped watching the news. I literally stopped watching.
See, after all, the dictionary has a word called governance, and of course that's being, if you put Google the meaning of the word governance, it'll say anything other than Congress. How's that?
Oh, that's good.
Yeah.
That's pretty good.
They had founding fathers.
Yep.
Yeah, I think supply chain is going to be all messed up now, and of course Santa Claus has come a little early, thanks to tariff is going to be paid by us eventually. Then they finally said, okay, we'll claw back on at least, no more duty for $300 billion, and Santa Claus comes on December 15th, right?
I guess so.
I don't know. It's capitalism is the best thing. We can't even handle it anymore. Yeah. It's sad.
Oop, hey, John, I got to take a real quick commercial break.
Bye-bye.
Hey, thanks for calling. You're listening to Bill Bullington right here on 1420. Stay tuned.
This is where I say I don't mean to have control. This is where I admit I don't know how to handle it.
And we're back. Hey, you're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon. You can also find this as a podcast on 955thefish.com. You can go to my website, Bullington Capital, which is under reconstruction. You're going to see that that works a whole lot better. I found out recently that we were not receiving a lot of our emails. Boy, is that upsetting. So took some action, got another programmer, and we're fixing that problem. That is not acceptable. So if you have inquired through the website, I apologize if we have not been getting back to you. But we're going to fix that lickety split. I think it's going to be in about 3 weeks. So the sign up portion of it, that works. When you sign up for a workshop, that works. It works actually. It's one of the better functioning parts of the website. So if you want to come to that workshop, I think this is a really good time. I think it's really important that people are paying really close attention right now. To look out for the Bull website. I keep talking about it. It's getting closer. I think it's a great educational tool that we're going to be talking about and utilizing going forward. I've got I ran some scans, and I'm even going to talk about this in the last 15 minutes of the show today. So if you're around, you probably want to catch that part. I think it's very good. The market is much stronger than it appears. The S&P 500's bouncing around a lot, and see, that's one of the problems with that. When the top 50 stocks make up half of the index, and there are 500 stocks in the index, that's just that one index. When the top 50 stocks are half, you're not getting an accurate picture of what the actual stock market is doing. It's not accurate at all. And so if you want more accuracy, I'm going to show you a couple of the scans that I run on a daily basis. It only takes a few minutes to look at it, and you can get a pretty good idea for how weak or how strong the stock market is. It's very helpful. Actually, it's very helpful psychologically, because intellectually, I'm telling you that those things can change direction in a day. The market can be in a well-established downward trend, and then it can turn around and everything starts running in a day. So it basically, it gives you an idea. The way that I use it is I look and I go, well, you know what? If I'm going to be buying and the market doesn't seem to be that strong, it's just not that strong, I'm probably going to buy a smaller amount than I would normally buy. That's what I do. And that's with the individual stocks. And I get people, incidentally, that want me to manage their money this way. I can't do that. I can show you how to do it, and I can tell you what I'm doing. I can show you what I'm doing. But I can't, because logistically, it's just impossible anymore. I have too many clients to be able to do that. And I'm going to tell you, it's fast. So if you don't, if you don't have a lot of time, this is probably not something that you should probably be doing. If you just really like it, that's why you should do it, because I'm telling you something else today. Every strategy that is out there has been knocked off by a fund in one form or another. So if you can think of a strategy, if you like momentum, there are a ton of momentum ETFs out there now. And you know what? A lot of them are pretty good. I use them. I only do the individual stocks thing because I really like doing the stocks. I really like it. I enjoy it. It's a hobby, and this hobby has the potential to make you money. How many hobbies do you have? I also like to shoot pistols. And that probably scares people when I say something like that. But the reason that I decided to learn how to do that was so that I wouldn't get hurt if I ever found a gun. I didn't want to blow my head off. So I took the classes. So gun safety, and I think that's important. But anyway, and in fact, I think I bought five firearms, and I gave them to one of my best friends because he keeps them for me. And if I ever want to shoot, he's there. And in the meantime, they're his. Those are his. But he'll bring them, and we'll go shoot. So actually, we shoot in the basement of that building that looks like a castle downtown, the Cleveland Grays Armory. It is kind of a castle. It was like a castle. It was a fort at one point in time. So I think it's really cool that it's still there. anyway, we'll talk more about that on a future show, but I got to go right to the phones right now. If you'd like to call 216-901-0945, and I go right to Jimmy. Jimmy, you have a question or comment?
Yeah, Bill. Say, I was reading an article a while back about passive investing and computerized trading.
Yeah.
And I'm told that makes up the majority of the activity in the stock market these days.
It's about half.
So, my question is, we're just along for the ride. Us individual investors, we are on whatever train they decide to go on.
Yeah, there's still a lot of active management going on, and it's about half. Which is big. I mean, that's astronomical when you think of, 15 years ago it was zero. To actually take up half, to have half of the market share of a market of that size over that short of a time period is unbelievable. And it has a lot of impact. I mean, a tremendous amount of impact. It's changed the way that stocks move. It has literally changed the way they move. They go faster up and down. The annual ranges are not all that much different. From top to bottom, it's not that much different. But how many times they will actually gyrate within that range, that's different. That's a lot different. So yeah, it's made certain things not as effective as they used to be, and then it's made some other things more effective than they used to be. So if you're not paying attention to it, like I do, you wouldn't know that, and it keep catching you by surprise. You don't want to be doing the same things that worked 10 years ago, because they're not going to. Well, you can do it. It just won't be as productive as it has been in the past. So, and by the way, you don't learn that stuff. That's not something that you predict that is going to happen. That's something that you learn by watching and observing the developments, which means by the time it becomes clear to you, it's already going to have taken place, and it's not too late to adjust, but you're not going to adjust before the market actually starts doing something like that. Does that make sense?
Yeah. Now, given the fact that we're going to be entering, we already have entered a pretty low interest rate environment. I mean, the stock market seems to be like the only game in town if you want to, have any earnings or growth. That's
my thought. You just read my mind. Where are you going to go? What are you going to do?
I mean, that's why, I don't see it really. I could see some minor corrections here and there, but, I don't see any major drops on the offing. I mean, because we're like I said, where are people going to make money?
Yep. And so here's what I don't know that anybody can, I can't for sure predict. And I've never seen a professional that made their living by predicting the short-term direction of the stock market. I don't think it's necessary. I look at the valuations. Valuations on stocks are very good. I was looking at the earnings yield, and the earnings yield is almost exactly at its long-term average over the past 25 years or so. Right now, even with companies like Google and companies like Netflix and Facebook, who are selling at valuations that are really, really high, if you take the averages, there are a lot of stocks that are selling below their averages. So if you take an average across the board, it's right where it's supposed to be. And that's a really good place to be. It means you're not overpaying. So if you're investing in stocks now, you're not overpaying. You look at the long-term returns on stocks relative to inflation, relative to bonds, relative to gold. Stocks are the clear winner. So I'm right with you. I'm like, yeah, you should be looking at this. And how you're going to invest, that's the key, because I was just talking about some of those momentum funds. You would not want to be investing in a momentum fund if you're in your 80s. That's just not something you'd want to do. You'd want to look at those companies that are paying dividends, that are actually earning more than the dividend that they're paying. And there are companies out there that put together funds that are doing that. So that's what I meant by, in some ways, it's a little easier and it's more effective than it was in the past. Because if you can think of a pretty good idea, somebody's already doing it. Now, they're also doing a bunch of bad ideas, like the pot stocks. Those pot stocks are way ahead of themselves. It's just like the internet stocks were in the late 90s. And we all know how that ended.
Yeah.
And some of those companies, like Amazon, they survived that period, and then Google, Apple, they survived, but Intel, Microsoft, their stocks went way, way, way down and took an enormous amount of time to recover. So that's the biggest risk that I see is people are investing in funds that have those stocks as major holdings. That's going to be disappointing. And they're probably disappointed if they look out over the past 5 or 6 years because those stocks have actually done better than a lot of the stocks that were more undervalued. But I'm here to tell you that will not stay that way forever. Eventually, value does matter.
Oh, absolutely. I agree with you. Value is where it's at for the long term.
Yep. Yeah. Yeah. And if I were
all right, Bill, thank you very much.
Hey, thanks for calling. I appreciate that.
Yeah, take care.
You too. Great call. That guy's name was Jimmy. But yeah, anyway. This is interesting. This just came up. I'm going through this scan. I'm looking at stocks with short-term upward trends. You want to talk about crazy? In one day, this stock called Purple. Purple makes a mattress. You see them on television or all over the internet, the Purple mattresses. One day, the stock's range was $11.04 and its low was $7.56. Are you kidding me? That is unbelievable. This is one of the risks of investing in super small companies. This stock just came public not that long ago. And they make a mattress. You see the ads on television all the time. It's kind of it's interesting. Just look at it. Go to their website. Anyway, the symbol is PRPL. Closed at $7.32 yesterday. And this is not one that came up in my normal scans because that wouldn't. But I'm looking at the price to sales ratio. If that's right, I'm gonna have to check. It's 0.17. That's really, really, really low. That's amazing. But the thing that stuck out about this, and it just shocked me actually, was that 1 day range. I mean, you're talking about 40% in a day. And from the closing price from the day before, I mean, that is just nuts. Hang on a second. Let me pull that up. That is hilarious. So it closes. Let's see. What did it close at? Okay. 813. Looks like the closed at $6.54 on the 13th of August. So $6. One more time. 813. No. Yes. It looks like opening price. Oh, this is hard. $6, right around $6.50. Okay, just call it $6.50. The next day it opens at $8.32. Okay, so that's like going from 65 to 83. It's like going from 65 to 83 overnight. Then it goes all the way up to 11. So let's put some other zeros behind this. So that's like going from 65,000 to 83,000 the next morning when it opens. Then it goes up to 11,000. Then it comes all the way down to 75,000. That is nuts. Yeah. Anyway, that is funny. I really like the company. I haven't. I did. I purchased one of their products. They had I think it was a seating product. It was for my one of my office chairs, and haven't bought one of the mattresses. But I'm gonna have to look into that. That is hilarious. It only came up on my scan because the range was so big for that day. I'll have a tendency to take a look at those things. Very counterintuitive for a lot of people. If you're looking at individual stock portfolios, and one of the reasons I think it's a good idea to learn momentum investing. Value investing, by the way, I have mutual funds for that. Well, not mutual funds, exchange traded funds. I rarely use a mutual fund anymore. Lots of reasons for that. We'll get into that at that seminar that's actually coming up. Seminar is September 12th. That's a Thursday night. We're going to talk about a lot of different things there. Trade disputes is the main thing, but I've got some very pleasant surprises for everybody there. One of them is about taxes, and particularly when I'm talking about momentum investing, the taxes and keeping track of all those transactions with a typical momentum portfolio is really a bear. I mean, you've got all these transactions going through when you're doing that. Those are very active strategies. And if you're doing it inside of an exchange traded fund, do you know that most of them convert those short-term gains into long-term capital gains and you don't have any reporting? How crazy is that? By the way, I have to give this disclaimer. Every time I talk about taxes, I'm not a tax preparer. I have I have a tax professional on retainer who will answer any tax questions my clients have. So, and I'm just telling you, whenever I talk about taxes, I have to always give this disclaimer. I'm not a licensed tax preparer. So you can't take what I'm saying as gospel. You have to go find and talk to a real tax professional to verify anything that I might say. Because I have been known to be wrong before, and being honest, everybody's wrong sooner or later because there's just too much stuff to keep up with. That's the other thing that kills me. Is today, you almost have to be a specialist in health insurance, and I got a really good one. I'm going to try to get him on the show. This guy's really, really good. Medicare, understands that stuff inside and out. Personal health insurance. You're dropping coverage or you're changing jobs. You need to make sure you stay covered. These guys, Packard Insurance, they're right in. My mind is going on me. They're only like 5 miles from me. Richfield. They're in Richfield. He's in Richfield, Ohio. So I have estate planning attorneys. You need to protect your assets. Ken Lano, it's a great one. He's a really good guy. If you're looking at, actually, I'm interviewing people to try to get them to come on my radio show for protecting yourself against medical expenses. That's a huge expense in retirement. So, and if something happens, you can end up losing a lot of money that way. Anyway, we have a network of people that we work with. That's another thing I'd like to address really quickly here. People think that we're a small firm. Bullington Capital is small. The firms that we deal with, Fidelity and E-Trade, they're huge. And they have a team of people. We have a team of people assigned to us at each one of those firms. The big advantage to this is, first of all, we have a team of people assigned to us at each one of those firms. When I worked for the big firm, they gave me one person. One. And she had to do everything. And I wasn't the only person that she had to work for. So that was rough. I get a lot more support now than I did then. And now here I got to take a real quick commercial break. Stay tuned. I'll be right back.
Filled with his praises, one day when sin was as black as could be, Jesus came forth to be born of a virgin. He dwelt among men, my example is he.
And we are back. Only got a few minutes left. If you'd like to call us, 440. My mind went blank. 901. What are the rest of the numbers? 0945? Yeah, okay. 216-901-0945. They're right in front of me, too. Yeah, that's what you get for getting old. Anyway, gonna go to the phones. Jerry. How you doing, Jerry?
Good morning, Professor. First, kudos on your music selection. I think it's great.
Thanks. I like it too.
Okay. Secondly, I would like to ask you, Bill, is there at this point a preeminent determinant on the market, what's going on? I'm talking about the Chi-Coms, what's going on in Korea.
Not really.
Hong Kong. Does it all have a cumulative effect? It seems like we got hit really, really hard last week, and then it, kind of stumbled back. But Is this just? You think it might just be the August blues? Or
Yeah.
You think we're?
Yeah, August is
Okay.
actually the worst performing month in the stock market. Yeah, people think it's October because they remember, 1987. But you know what though? The millennials, they weren't born yet, so they don't know.
I don't think either you or I were born then either, though.
In 87?
Oh, I'm talking about October 1929.
Yeah, no. Yeah, I wasn't born then either. But we had heard about that from our grandparents and our
You
parents.
got it.
Yeah, so
You got it.
yep. But
What do you- Go ahead. I'm sorry.
no, it's the cyclical nature is not. It's not all that cyclical. It'll change. It's constantly changing. That's the one thing that I find that is constant in the stock market is change. A lot of things that worked 10 years ago are nowhere near as effective as they used to be. It's not even close. But then a lot of other things have become more effective. So that's one of the reasons you want to kind of stay tuned and pay attention, because it can make a big difference. And it is pretty difficult. It's pretty painful, by the way, when you go through the periods where something stops working, because everything has a period where it's going to underperform from time to time. Nothing outperforms all the time. But you never really know, is this just a cycle, or is this have things really changed? And I think it's pretty evident to me anyway that markets have changed. They don't move the same way they did 10 years ago. I attribute most of that to the growth in exchange traded funds, which are all run by computer algorithms, and it's fine. It's actually made the more traditional style of buy some small cap, mid cap, large cap, internet emerging market. It's made that work. Actually, it works better than it used to. And some of the momentum stuff, actually, if you make an adjustment, I'm going to show this at the seminar. If you adjust, it's actually working better than it used to. It's a lot faster.
When is the seminar, Bill?
Hang on a second. I think it's September 12th. Yes, September 12th.
Okay.
Yeah, it's going to be 6:30, same place, Corporate College. And it's funny because I put that up and I forgot to put the address on it.
Okay. Bill, what do you make of the conundrum in Hong Kong? Are the Chi comps going to get heavy, or are they going to let this thing roll
I
out?
don't know, man. See, here's the thing about China. China, their livable land area, the area that can be inhabited, that can build on, is the same as the livable land in the United States. They have 1.3 billion people. We've got 330 million. Okay, so you multiply our population by 4. Imagine the number of problems you would have. And think about that. If there were 4 times as many people, and let's say the amount of problems actually didn't increase, they decreased as a percentage of the population by 1/3, we would still have 3 times the number of crimes going on. It would be it'd be crazy. So I'm amazed that China works as well as it does at all. And the reason that we work as well as we do, I think it keeps coming back to we have a fractional reserve banking system that's been tested throughout the last couple hundred years or so, and they are continually learning and continually improving. And that's one of the reasons that we're the world's largest economy. We're only 5% of the population. It's our banking system.
Do you agree that should the Chi coms take over Hong Kong, or militarize it, that it would be the end of what's the correct word? A good time in the world's economy? It would be devastating, wouldn't it?
I don't have enough knowledge or enough information to have an informed opinion.
I had heard that almost 30% of China's wealth was funneled through Hong Kong, through the banking and financial sector, so forth and so on. It seems like an inordinately large amount, but I mean, it very well could be.
Well, and I can tell you that the only thing I really know about this, every time somebody brings this up, the HSBC, do you know what that stands for? That big bank?
Please refresh my memory. I have heard it, yes.
It's Hong Kong Shanghai Banking Corporation.
There you go, okay.
And it was started in 1830s by some Englishmen. The Englishmen were there to escape the taxes of England. In other words, none of this is new. None of this is new.
But China's muscling them out is certainly
right.
new.
They're trying to, and I'm not. Do I think that there's some risk there? Yeah, I think a lot of those companies like HSBC that were founded there because it was an independent province and they could basically had freedom from being taxed or overly regulated. Well, they'll just have to find a new place to do that, and there are plenty of places around the world that can happen. Will that slow things down? Yep, because they're going to have to move. I mean, they would have to move. They'd literally have to leave the country. So that could slow things down. That could slow the entire world economy down, but it's not like it's going to stay down.
Okay, one last question. Gold's been on the move lately. Have the gold stocks done better, or is gold itself?
You know what was really wild? The gold stocks moved about 2.5 weeks ago. They were all moving about 2.5 weeks ago, and then gold starts to take off. So I thought that was pretty funny. That's one of the reasons that I'm always looking at the individual stocks, because they will often foretell what's going to go on in the larger market at some point in time. And not always, and nothing's perfect, but it was an assumption. And I've got this guy who's a gold, and every time I see these gold stocks, he's a gold bug, and I just think about him. Just like I wonder what he's what he's doing today. But it's pretty funny. I'd seen those coming up for a while, and if you look at the ETF, the GLD, that Spider Gold Trust, that thing's it looks like a breakout stock. It's run up quite a bit. So,
too late now to get aboard?
You don't know. Nobody knows. Okay. If I were to do it, I would put my trailing stop at the low of the last month. Whatever that was. That's where I'd put a trailing stop on that if you were decided that that's what you want to do.
Gotcha. All righty. Thank you, Bill. Have a great week.
Thanks. You too.
Yeah.
And I got Matt. Matt, you're on the Bullington Capital Report.
Hey, Bill. How you doing?
Good.
Good. So I kind of just wanted to talk to you about alternatives. I've read a whole lot about kind of the mindset starting to change, from the traditional 60-40 of stocks and bonds, and, adding alternatives and hedging strategies. And so about a month ago, like when the VIX was really low, I picked up some shares of VXX and made some money in the last few weeks. But I just kind of wanted to ask you about, what type of hedging strategies, and I know you want to be careful you don't hedge too much because then you miss out on gains and growth. But what types of hedging strategies do you recommend or think about?
I think you should probably get with a professional that focuses on that. So we have a program with a company called First Trust. They're one of the largest ETF providers in the country. And they will hedge. They'll actually do a hedge for you. They do a collar. And a collar gives you some freedom. It kind of caps the amount that you can make, but it also caps the amount that you could lose. So I think if you're really, really worried, that's probably a good idea. The cost to that is like if you're capping your gains, and market runs up 30% and you're capped at 15, you're not going to make more than 15%. So that's your, and I think that's probably the best way I can think of to do that, because when you look at the cost of the carrying cost on options for retail investors, even institutional investors, man, it's expensive. They really charge a lot of money to hedge your portfolios, almost to the point that it's just not worth doing. That's one of the things I don't like about the equity indexed annuities, because they're paying those retail prices for hedging those portfolios, and you're going to be lucky to have made any money at all, and I think you'll probably end up making more money in a money market paying 1% if you look out over in the future. In the past, those costs were significantly lower. You could actually get away with it, and it was a good idea. I remember doing it back in the mid 90s, and then the insurance companies started doing it, and the more people you get doing something, the more expensive it tends to become. And just as a rule, and when it got too expensive for me, I just opted out. So, I'm just going to go with my hedge is going to be the short-term cash that I'm holding in my accounts. Mm-hmm. And that's going to be my hedge. And I'm going to buy quality and I'm going to manage my risk. So whether it's an exchange-traded fund that I know very well, and the exchange-traded funds that I know I'm going to add to, if the market does correct, I'm watching the market. When it corrects, I'm hanging on that. I'm hanging in there. When it starts to give signs that it's bottoming out, and these are just my signs, and I'll talk about them at that seminar. I don't have time today, but I'll end up increasing the exposure. I'll rebalance my portfolio. What that does, it takes money out of the safer stuff and adds it to the stocks, and that can be a huge help. But I'm willing to put up with a fairly significant amount of fluctuation, and because I know that in the long run my returns are better because of that. In the short run, when you're holding, you got 30% of your money in short-term bonds and the market goes up 30%, makes you feel pretty crappy.
Oh yeah, right.
But you got to take the long approach and just look out in the future and just be good with it. But hey, man, I hear the music. That means I got to go.
Hey, have a great weekend, Bill. Thanks for taking my call.
Thanks for calling. And you've been listening to Bill Bullington here every Saturday morning from 11 to noon on 1420. Don't stay tuned. Yes, stay tuned. Listen to the other shows. Have a good week, everybody. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420. The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.